Have you ever stopped and really thought about why the U.S. government gives tax breaks for saving for retirement? I mean, it's clearly a nudge, right? They want you to save. But the whole landscape, the incentives, the different kinds of plans, the tax rules, it can feel, well, pretty complicated, like you're navigating a maze. So, on the deep dive today, we're going to try and cut through some of that fog, our mission, to really dig into employer sponsored retirement plans, specifically from a tax angle. We'll unpack the various types, what makes them tick, and what it all means for taxes, whether you're the employer or the employee. The goal is simple: clarity, making sense of the jargon. Okay, but before we dive deeper, just a quick reminder, this deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we're about to discuss, they come straight from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student studying for exams, a CPA candidate prepping for the big test, or even a professional looking to brush up, I really recommend checking out their website. You'll find extra practice questions, video lectures, tons of detailed support to reinforce what we covered today. A big thank you to Professor Farhat for making this excellent material available. All right, so let's unpack the why first. The basic idea seems pretty straightforward. Congress wants people to save for retirement. But, the big question is, how do they actually do that? What's the mechanism?
Fundamentally, it really boils down to tax benefits. That's the main carrot they dangle. Usually this takes the form of a tax deduction or maybe an adjustment to your income. You'd see this on something like Schedule 1 on your Form 1040 tax return. And what's really key here is that these breaks aren't just for people working at big companies. They apply if you're self-employed too. It's basically the government saying, look, put money away for later and we'll cut you a break on your taxes right now.
That makes sense. So tax deferral is the key concept. We hear that phrase all the time, tax deferred. What does that actually mean in practice?
Yeah, it's a crucial term. Deferred simply means later. So think of it like this. You put money into your retirement plan today, right? And usually that money goes in pre-tax.
Pre-tax meaning I haven't paid income tax on that specific money yet.
Exactly. You haven't paid tax on it yet. Then that money gets invested. And here's the really powerful part. It grows, accumulates earnings without you paying taxes on that growth each year. The taxes are deferred. They only come due way down the line in the future when you actually start taking the money out in retirement.
Okay, so the benefits for me, the individual, are pretty clear then.
Oh, absolutely. There are a few big ones. First, you get an immediate tax saving today because your taxable income is lower. Second, your investments compound faster because the earnings aren't being taxed along the way. Tax-free growth is huge over decades. And third, you delay paying the tax until retirement when, you might be in a lower tax bracket than during your peak earning years.
That makes a lot of strategic sense.
It does. And a simple rule of thumb helps here. If the money went in before taxes were paid, the whole amount you take out later contributions and earnings will be taxed as income. But if you used money you already paid taxes on, like with a Roth account, then your original contributions usually come out tax-free later. Earnings might still be taxed, depending on the plan specifics, but the principle is clear.
Got it. Okay, so let's get into the different types of plans employers offer. It feels like there are quite a few out there.
There are definitely several variations. Today we'll focus on the main employer-sponsored categories. We'll look at qualified pension plans, the traditional ones, then profit-sharing plans, of course the big one, the 401k, and its relative, the 403b. We'll also touch on KEO plans, those are for self-employed folks, and then two designed for smaller businesses, SEPs, simplified employee pensions, and simple plans.
Let's start with pensions. You called them traditional. They almost feel like finding a unicorn these days for many younger workers, but if you have one, it's a huge deal. I actually heard a story once about someone who taught like 1 or 2 classes part-time at a state university. They didn't even realize it, but they got automatically enrolled in the state pension. Years later, they took a full-time job somewhere else and discovered, hey, they actually had a pension building up. It just shows how these things can sometimes work quietly.
That's a great illustration. They can definitely build value behind the scenes. A qualified pension fundamentally guarantees you a certain income in retirement. That's the key. You have to meet the requirements, like vesting, but the benefit amount is defined up front. That's why we call them defined benefit plans.
Right, defined benefit. You know what you're getting.
Exactly. You often see these for police officers, firefighters, government workers. Their salaries might not be the absolute highest during their careers, but this secure retirement income is a major part of their compensation package. Historically, pensions were much more common in the private sector too, but they have become really expensive for companies to fund and manage. That's why you don't see many new ones. And there are rules to protect employees. The money set aside for pensions has to be held by a separate trustee, not the company itself. So if the company goes under, the pension funds are safe.
How is the actual benefit usually calculated?
It's typically based on things like how many years you work there. Maybe you need 10 years for a partial pension, 20 for a full one, something like that. And it's often tied to your salary, usually an average of your highest earning years, like your final 3 or 5 or 7 years.
Okay, and you mentioned qualified pensions. What makes a pension qualified?
Ah, yes. To get the tax advantages, pensions have to meet strict IRS rules. Big one, non-discrimination. They can't just benefit the owners or the highly paid executives. They need to cover a broad range of employees.
So, no special deals for the bosses.
Pretty much. They also have to have clear vesting schedules. That means telling employees exactly when they gain ownership of the employer's contributions. It might be after 2 years, 5 years, 7 years, depends on the plan. And they generally need to cover a good chunk, like at least 70% of the company's non-highly compensated employees. Participation is key.
And if they meet all these rules, what are the tax benefits?
They're significant for both sides. For the employer, any money they put into the pension fund is an immediate tax deduction for the business. Plus, those contributions aren't considered wages for things like Social Security, Medicare, or unemployment taxes if you didn't SUTA. That saves the employer money.
And for the employee?
For the employee, the money grows tax deferred. You don't pay any tax on the contributions or the investment earnings until you actually receive the pension payments in retirement, usually starting around age 59 and a half. And as we said, it's typically a defined benefit, which means less risk for you compared to plans where the payout depends on market performance.
That distinction between defined benefit and defined contribution is important. Let's shift to profit-sharing plans. Those are defined contribution, right?
Correct. Profit sharing is a type of defined contribution plan. The key thing to know about these is that they're usually discretionary. The company decides each year whether to contribute and how much based on how profitable the business was. If profits are down, they might contribute less or even nothing.
So more flexibility for the company.
Exactly. That makes them attractive, especially for smaller businesses where profits might swing year to year. They aren't locked into making contributions if they have a bad year. It can also be a good motivator, linking employee rewards directly to the company's success. If the company does well, everyone potentially gets a bigger slice.
Do employees contribute to these two?
Typically, no. Profit-sharing contributions usually come solely from the company's profits. When an employee leaves, they might have the option to take their vested amount as cash, which would be taxable then. Or they could potentially roll it over into an IRA to keep it tax deferred. There are rules around rollovers, of course, and you often see companies offer a profit-sharing plan alongside something like a 401k. That way, employees still have a retirement savings vehicle, even if there are no company profits to share in a particular year.
Okay, let's talk about the 401k. It feels like the main retirement plan for so many people working today. I always thought the name sounded so technical, just an IRS code section.
It does sound a bit dry, doesn't it? But yeah, Section 401k of the Internal Revenue Code. Essentially, it's a type of qualified profit-sharing plan, but with a twist. It allows you, the employee, to choose. You can take your compensation now as regular taxable salary, or you can elect to defer a portion of it into the 401k plan.
And that deferred money goes in pre-tax.
That's usually the case, yes, pre-tax, which is incredibly powerful. Let's take an example. Say you decide to contribute $10,000 this year, and let's say your marginal tax rate is 20%. By putting that $10,000 into the 401k, you immediately shield it from income tax. That's a $2,000 tax saving right off the bat just for saving. Then that whole $10,000 grows tax deferred. The earnings compound year after year without being taxed until withdrawal. It's arguably one of the most effective wealth-building tools available to employees.
And often the employer kicks in something too, right? A match.
Very often, yes. Employer matching is a common feature. They might match your contributions dollar for dollar, or maybe 50 cents on the dollar, up to a certain percentage of your salary, like say 3% or 5% or even 6%.
That's basically free money.
It absolutely is. That employer match is a guaranteed return on your savings, on top of the tax savings and potential investment growth. That's why financial advisors always say to contribute at least enough to get the full employer match. Now, there are limits on how much you can contribute each year. These limits change, but for 2020, for example, it was $19,500 if you were under 50. And if you were 50 or older, you could add an extra catch-up contribution, which was another $6,500 back then. So older workers could put away even more.
Are there limits on the employer match too?
Yes, there's an overall limit for the combined contributions, what you put in plus what your employer puts in. In 2020, That total couldn't exceed $57,000. These numbers adjust for inflation most years. And if you accidentally contribute more than the individual limit allows, you generally need to get that excess amount returned to you by April 15th of the next year. Otherwise, it gets counted as taxable income. And just like pensions, these 401k plans also have to follow those non-discrimination rules to make sure they're fair to all employees, not just the highly paid ones.
How does this show up on my W-2 form at tax time?
Good question. Your W-2 will reflect this. The amount reported in Box 1, which is your wages subject to income tax, will be lower because of your pre-tax 401k contributions. Interestingly, though, your contributions usually don't reduce the wages used for Social Security and Medicare taxes. Those are typically calculated on your gross pay before the 401k deduction. And there's usually a specific box, Box 12, on the W-2, where your retirement plan contributions are coded and listed.
What about taking money out early, before retirement age?
Generally, if you withdraw money before age 59 and a half, you'll face a penalty. It's typically a 10% penalty on top of the regular income tax you'll owe on the withdrawal.
Ouch. Are there exceptions?
Yes, there are several common exceptions where you might avoid the 10% penalty. Things like the plan being terminated if you leave your job, the rules apply. Death, becoming totally disabled, or certain financial hardships. We've actually seen Congress temporarily relax some of these hardship rules during major events like the housing crisis years ago or more recently during the pandemic to give people more access if needed.
And you mentioned the 403B briefly.
Right. A 403B is very similar in concept to a 401k, pre-tax contributions, tax-deferred growth, but it's structured specifically for employees of certain organizations, typically public schools, universities, hospitals, and other nonprofit tax-exempt entities. Functionally, very similar for the employee.
Okay, that covers a lot of ground for traditional employment. But what if you work for yourself? You're a freelancer, consultant, run your own small shop. How do you get similar retirement tax breaks?
Great question. That's where KEO plans, sometimes called HR 10 plans, come in. They're specifically designed for self-employed individuals and unincorporated businesses. Since you're effectively both the employer and the employee, a KEO plan lets you make contributions for yourself, similar to how a corporation contributes for its workers.
Do the same kinds of limits apply?
Yes, they're subject to similar overall contribution and benefit limits as other qualified plans. For contributions, the limit is generally the lesser of the annual maximum dollar amount. Again, that $57,000 figure from 2020 is a good reference point, though it changes, or 25% of your earned income.
Okay, earned income for a self-employed person. How is that calculated for the KEO limit? It sounds like there might be a catch.
There's a bit of a specific calculation, yes. The earned income used for the 25% limit is your net self-employment earnings after you deduct 1/2 of your self-employment taxes and also after you deduct the KEO contribution itself.
Wait, after you deduct the contribution itself, that sounds circular.
It is a bit circular. There's a worksheet or a slightly adjusted calculation method to handle that. Effectively, it works out to be equivalent to contributing 20% of your self-employment income before deducting the KEO contribution.
Okay, maybe an example would help.
Sure. Let's say someone, call him Sam, has net self-employment earnings of, say, $60,000 after accounting for half of his self-employment tax, but before his KEO contribution. His maximum deductible KEO contribution wouldn't simply be 25% of $60,000. Because of that circular calculation, it works out to be $12,000 in this case, which is 20% of the $60,000. We're looking at it the other way. $12,000, 25% of $48,000, which is the $60,000 minus the $12,000 contribution.
Ah, okay. The math is tricky. But the point is, there's a way for self-employed people to make substantial tax-deductible contributions.
Exactly. The takeaway isn't necessarily memorizing the formula, but understanding that KEO plans provide a robust way for the self-employed to save for retirement on a tax-advantaged basis, comparable to what employees get through corporate plans. The maximum contribution possible is tied to maximum compensation limits, ensuring parity.
Makes sense. Now, you also mentioned 2 other plans aimed at smaller operations, SEP and Simple. How do those work?
Right. These are designed to be, well, simpler options, especially for small businesses who might find the rules for traditional pensions or 401ks a bit too complex or costly. Let's take the SP first, the Simplified Employee Pension. This is mostly used by small businesses and sometimes sole proprietors. With a SEP, the employer sets up an IRA, an individual retirement account for each eligible employee, and the employer makes contributions directly into that IRA.
So it uses an IRA structure.
Yes. And like the others, the money goes in pre-tax, gross tax deferred, and is taxed upon withdrawal, typically after age 59 and a half. The key difference with a SEP is that only the employer makes contributions. Employees don't contribute themselves.
Only the employer. How much can they contribute?
The employer can contribute a percentage of the employee's compensation, up to 25%, with that overall dollar limit we mentioned earlier still applying, $57,000 in 2020. And importantly, if they contribute, they generally have to contribute the same percentage for all eligible employees.
Who counts as eligible?
Generally, an employee is eligible if they've worked for the company in 3 out of the last 5 years and earned at least a relatively small amount, like $600 in the year. That threshold also adjusts.
Okay, so SEPI is employer-only contributions into employee IRAs. What about the simple plan?
Right, the Savings Incentive Match Plan for employees, or SIMPLE. This one is specifically targeted at businesses with 100 or fewer employees that don't already offer another qualified plan like a pension or 401k. It can be set up using either an IRA structure, simple IRA, or a 401k structure, simple 401k. Again, pre-tax contributions, tax-deferred growth, taxed at withdrawal after 59 and a half.
What's the key difference here compared to SEP?
The big difference is that with a simple plan, both the employee and the employer typically contribute. Employees can choose to defer part of their salary, similar to a 401k.
Are the employee contribution limits the same as a 401k?
No, they're generally lower than the standard 401k limits. For 2020, the employee limit was $13,500, plus an additional $3,000 catch-up if you were 50 or older. Still significant, but less than the regular 401k.
And the employer contribution, how does that work in a simple?
The employer must contribute in a simple plan, but they have a couple of options on how to do it. Option 1, they can make a matching contribution, usually dollar for dollar, up to 3% of the employee's pay, but only for employees who are actually contributing themselves. Option 2, they can make a non-elective contribution of 2% of compensation for all eligible employees, regardless of whether the employee contributes or not. They have to choose one of these formulas each year.
Who's eligible for a simple plan?
Eligibility is usually based on earning a certain amount, like $5,000 in the preceding couple of years, and expecting to earn that much in the current year. There might also be an age requirement, like 21. And there's one quirky rule with simple plans to be aware of. There's a 2-year waiting period from when you first participate before you can withdraw money penalty-free, even if you're over 59 and a half.
Really? So if I join at age 58 and a half, I can't touch it without penalty until I'm 60 and a half?
Exactly. That 2-year clock starts when you first join the simple plan. It's designed to encourage longer-term participation.
Wow, okay. That's a lot of detail across all these different plans, but incredibly helpful. Understanding these options really feels fundamental for anyone thinking about long-term financial planning and managing their taxes effectively. It definitely shows how getting a handle on this information, even though it seems dense, can really pay off.
Absolutely. Knowing these distinctions, the contribution rules, the tax implications, it empowers you to make much better financial decisions for your future. It's not just about understanding jargon, it's about understanding how these tools can help you build security. And that naturally leads to thinking about your own situation.
Right. So after digging into all of this today, pensions, profit sharing, 401ks, KIOs, SEPs, here's something to consider. What's maybe one concrete step you could take this week? Could you review your own retirement plan statement with fresh eyes? Maybe check your contribution levels. Or perhaps even just prepare a couple of questions to ask your HR department or financial advisor about the specific options available.